I'm actually talking today about something different. I do a lot of futures trading. I do a lot of stock options trading. But the futures trading has come into the spotlight big time in the last couple of weeks just because of the increased volatility. So what I'm going to talk about today applies pretty much to Monday's trade, Tuesday's trade, and for the foreseeable future because volatility has increased. And it's called trading low-risk tops and bottoms. A lot of people say you can't make money trading tops and bottoms because you can't. Nobody's smart enough to define a top or a bottom, and that's why I'm calling it trading low-risk tops and bottoms. I'm not calling it identifying every top and bottom. It's just trading low-risk tops and bottoms as a way to catch reversal patterns. But I'm going to show you how to spin that if you choose to drill down in your time frames. You can spin that and actually follow the trend of intermediate tops and bottoms. So what you can do is identify where you're going in the market and then look for reversals and continuation patterns. So that's right now with the market conditions like they are, this is my favorite intraday trading strategy. And for my core positions, these low-risk tops and bottoms, the way that I identify them, actually give me the swing analysis on daily charts, and I don't even have to change my strategy. All I do is update the chart from an intraday chart to a daily or weekly chart, and I don't have to adjust my thinking at all. So very, very powerful. Hope you get a lot out of it. So let's get into the presentation. First things first, risk disclosure. You've got trading. I'm going to be showing hypothetical examples. I have traded some of these examples. Some of them are there for educational purposes. That's just a disclaimer that I have to do because I am a licensed in the state of Virginia as an investment advisor, and we do have to show these rules and the CFTC rule 4.41, which probably everybody else is showing as well. So let's see if I can get here. There's one thing that is more important than trading as far as the X's and O's of trading, and that's your mindset and why you're trading. And so how big is your why? And I take this quote because it's a very familiar quote, but your mindset is the most important asset you have in your trading. And if you are taking this as a hobby or as a secondary priority in your life, then you're going to get the hobbyist or the secondary results. If you're taking it to supplement your income in a way that you're taking it serious, then you're going to have an edge over everybody else. So what I talk about is how big is your why? And when the why is big enough, the how becomes easy. And the reason I do that is because this is my why. I've talked about, and you heard in the bio, my wife, my kids, trading and active investing gives you the flexibility that you can put your attention where it should be, and well, where I think it should be, and that's on your family or whatever's important to you. And this is what's important to me. I just want you to know that it's real world. I'm a person just like you guys are, and I have a family that, like I said, and that's why I wanted to take the time to thank you guys for being here, because I'm taking time away from my family to be here, and I do know that the sacrifices that we make in order to try to get to our goals, and that's what I want to help you get to today. So let's get into the low-risk tops and bottoms. And before I do that, I briefly mentioned upon this as far as the market conditions that have changed in the last couple of days. We have had, I don't know if you guys were trading in 2005, 2006, but 2012, 13, that's felt a lot like 2005 and 2006. We've become complacent. We've become, every dip is purchasable and we'll just buy and hold and the market will go up and we'll get rich. That was the sentiment in the market, back after the 19, let's call it the 2000 tech bubble. People got a little scared, and then time went by, and time heals all wounds, right? So once that time healed all the wounds and people had kind of picked themselves back up, they got complacent again. And in 2007, 2008, we all know what happened. For a trader, and I was not as experienced as I am now, so as a trader, the first few days shocked me, and in 2008, 2007, 2008. And now what I found is you're able to, as you get more experience, you're able to ebb and flow a whole lot better. So maybe the first hour, surprised me when you start seeing the Dow tanking for 100 points or something. But you adapt real quickly and you start drawing on those experiences from the past. And I'm going to tell you that 2008, even when I was, wasn't a junior trader, I'd been trading for about 2 years full time, 2 or 3 years. 2008 was my best performing year because it's a trader's dream. These market conditions, if you understand what the previous speaker was talking about, the volatility, where to put those put spreads, where to take those trades. The volatility actually helps increase option premium. Well, the same thing in the markets, what you're doing is you're increasing your profit potential if you're an intraday trader. So there's a lot of benefits for what's going on right now if you embrace it and if you have a plan that can benefit from it. So let's talk about that volatility and put some numbers around it. I'm going to grab the pen, the marker here. Hold on one second. It's on. I'm going to move this over closer to the screen I'm sharing. The pen, can I write? I don't have the right color, I guess. So let's choose the pen. All right, so there we go. What you're looking at here on this chart is a chart of the Dow from a daily perspective. And you can see the complacency. We came down, we can buy the dips, and you just hold and the market pays you, gets back up here. We're at this 17,000. You can see these very small range candles right here. Well, you look at the past couple of weeks and you're seeing huge up days followed by huge down days, huge up days, a big old gap up and it held, so the volatility is increased. Well, what does that mean to a trader or to an intraday scalper or even to you as an individual investor? Well, actually, and let me take a quick second here. How many people trade intraday versus trading stocks? Do you day trade or are you more of a swing trader? Does anybody in here day trade? They do both day trade. Okay, so and futures, I assume you would use futures as well. Okay, so both futures, good. So you guys should really understand what I'm saying here with this slide. What you've done is you've gone from an average range of about 120 points on the Dow. That gives you a little bit of profit potential, right? Well, you've gone from 120 to 274. What does that mean for your, whoops, sorry about that, hit the wrong button. What does that mean for your trading? Well, there's a thing that's called the ATR, the average true range, and what that does is it tells you how likely you are to get a move in the stock market or what type of move is going to develop. And in this case, we were looking at 120 points. Once you get that far in the stock market, price tended to stop or stall out. Once you go down 120 points, it tends to rebound. And you need to know that because the ATR is very important. When you couple the ATR, you take that and you put that with the dollars per point, you get a daily range or a daily move in the market. And when you get to these ranges, a lot of times the market is going to stop. So let's look at the 120 ATR. What is your profit potential in the Dow if you're trading at 120 ATR? Well, a 120 ATR times $5 a point gives you around, and I'm going to use some round numbers, the 120 is easy, that's $600 a day. So if you're trading this and you're looking at this thinking, wow, $600 a day, that sounds good. But I've already told you that tops and bottoms are hard to catch, right? So if you miss the top third and you miss the bottom third, how much does that leave you in profit? You only get 33% of that, right? So, and I'm going to use round figures here, $200. And there's some math majors in here, obviously, because you guys are really, really quick on the math, so that's a good thing. When you have a $200 profit potential, you have to be pretty daggone good, or you have to trade multiple contracts to make what most of us want to make as a living. Okay? With the 274 ATR, what kind of profit potential does that give you? $1,370. Okay? So do you think it's easier to make $200 if you've got a $600 range, or $200 if you make a $1,370 range? Obviously, it's much easier if you've got a $1,370 range. Now, what does that also mean? Where there's risk, there's reward, right? So if you have the increased reward, you're going to have the increased risk. Well, yes and no. Yes, you're going to have the ability to, make more, but you don't necessarily have to risk more. You can still risk the same amount. You just do it in a different way. And that's what I want to talk about, is how you identify where you take that risk and where you take that reward. Here's a slide that just, shows just about every stock index that's related. All the index futures have gone from 16. The S&P's gone from 16 to 36, which is $800 to $1,800. Now, what I haven't shown is, since I want to focus on the index futures because that's what's really increased in volatility. Now, crude oil, you can still make $1,500, $1,800 range on crude oil any day, but it's a whole lot, I would say it's a whole lot harder to trade than it is the stock indexes. You don't have as much information, and you have a lot of that is a news-ridden market. You can get some sudden explosions, a really fast-moving market that if you're not careful, it can hurt you. The indexes can hurt you as well, but let's go into how you can protect yourself there. So let's talk about how to identify the tops and bottoms, since we know, number one, that there's potential to make some really, really good money right now in the stock indexes, in the stock index futures market. And this goes, if you don't trade the futures market, this can go to ETFs as well. You've got the diamonds, the spiders, the Qs, all of those. You can trade those, or you can use this information to adjust your stock portfolio and get more out of your options plays. So you don't have to be an intraday trader to benefit from the increase in volatility. You just have to have a plan. So let's talk about one aspect of that plan, is trading those tops and bottoms. And I've got to take you back for a little bit, and I've got to simplify things, because when all of this comes together, you need to understand the simple market structures, okay? A simple price pivot, and I'll grab the crayon just so you can see exactly what I'm talking about. The simple price pivot is nothing more. If you look at a candlestick chart, or if you look at a bar chart, this is going to look like this, and then this candle would look like this right here. So it doesn't matter if you're looking at a bar chart or a candle chart. Your main concern is, if I'm coming down and I get a lower close right here, a red candle signals lower close, if as the first bar that I get that turns green, the very first bar that closes higher than it opens in a downtrend, is a simple price pivot. Now, it sounds basic, and I know you guys are saying, oh wow, that's trading not even 101. You can learn that just by anything that you get. Yes, but this becomes real important when you combine it with an additional aspect. A difference between a simple price pivot and a confirmed or complete price pivot. What am I meaning by that? When you get, here's candle, the first candle and the second candle that creates the simple price pivot, right? We just went over that. You're in a downtrend, and you get a closing candle, and then you get a higher close. This is your simple price pivot. A complete price pivot is, well, and this is actually an engulfing pattern, but yeah, I mean, some of them can be haramis. Some of them can, it doesn't have to be a specific pattern. It can be just a higher close, okay? What you're looking at here is once you get this, in order for this to be a complete pivot, you have to go back. The bar here, the last bar, and this bar cancel each other. So you disregard them. So you go back to your previous bar. And when you take out this high, this means that the market, and I'm talking about market structure here, the market has said, okay, the buyers have stepped in and taking control of this market, right? The bulls are in control now. Now, does that mean it's going to go up forever? No, it just means for the time being, in this case, period 4, period 1, 2, 3, and 4, the buyers are in control. Price can still come back down here, and that's what we're going to talk about. But what I wanted to make the distinction of is when you're trying to call a top or a bottom, when you're trying to call, highs and lows in the market, you're going to get simple pivots more often than not. That's not where you get your edge. Where you get your edge is on these complete patterns, okay? When you get this close higher, that's where this level right here is your clearly defined risk, okay? You've got your clearly defined stop point and a completed pattern here. Why is that important? Well, because we're going to build upon this simple concept, okay? And this is going to be what this move looked like. Here was the simple price pivot, and you can see you never confirmed. Here's the complete price pivot, and you got a little follow through. Now, obviously anything's not 100%, but what you're going to look at is you're going to look at these patterns being your edge versus just any higher close. Now, the higher close gives us swing points, right? This is a market temporary swing point. It's taken out, but it's a swing point nonetheless. The market made a decision to go lower here, okay? So what I want to look at here is I want to combine these techniques to give me a pattern or a method where I can comfortably use a decent stop according to, to the ATR and have a reasonable expectation that price is going to go the direction that I want it to. Now, how do we do that? Well, one other important aspect. So I talked about price pivots, and I'm going to tie this in because this is called a level of interest or an area of interest. So we've talked about those levels, and let me go back. Well, I can't go back right now. I'll go back at the end and make sure you guys understand this. But right in here, when you've got your simple price pivots, the lowest bar that you have is going to be your pivot point. Now, I know I'm throwing a lot of terms at you, but I promise I'm going to bring it together here in about another 4 or 5 minutes. So if you've got your pivot point, those levels, when you look left on the chart, are going to come into play. And you can see right here, I've marked the pivot level, and it's just on the simple pivot. Once you've completed this lowest bar, the range, the high to low of that lowest bar becomes really, really important. So you draw lines and you can draw them out. You can see we came down, we made a decision, we broke through. Well, when you come back and test this area, you should get, resistance. Once support is broken, it's turned to resistance. Again, basic principles. But when you combine them with the pattern or the technique that I'm going to show you here, then it becomes really important because this becomes a predictive level, right? Once you've broken down, what happens in the market? People get emotional, right? When the market's falling down here and this tail right here, people are getting emotional. There's two types of traders that are going to be overcome with emotions. They're going to be those that are short, and they're going to be thinking about, where they're taking their next vacation, and they're not going to be paying attention to the markets because they're going to think about, how they're spending it. They're looking up on, Priceline or wherever to find the next deal, right? And then there's going to be those that were long that are getting run over that are feeling a whole lot of pain and can't take it anymore. Either way, you're going to get a retracement, and people are going to forget about this level. Why do people keep forgetting about it? Because you have, different traders taking on the different emotions, okay? So let's look. Don't forget about any swing point that is in the market under the time frame that you're trading. Now, this happens to be a 2-minute chart. It doesn't really matter what chart you're trading. The tick charts, the intraday charts, get a little hard to read this. So I do recommend, time frame charts, like 2-minute, 5-minute type charts, to look at these points, because these are levels that you want broken clearly before you start using them. Okay, now that's real important, because we're going to put some structure and try to identify this move right here as a high probability top or bottom. Okay, so let's talk about one more thing before we dive into some patterns and setups. We're going to talk about an oscillator. Does everybody know what an oscillator is? An oscillator, by Investopedia's definition, is just an analysis tool that is banded between two extreme values. Now, in layman's terms, oscillators indicate in the trading world, oscillators are overbought, oversold indicators. Okay, you see it right here. It's overbought and oversold conditions. And if you didn't know what an oscillator was, I know you know what types of oscillators are, because when I show this next chart, you're going to say, oh, that's an oscillator. Okay, it's an indicator. Well, the indicator that has certain characteristics, it's going to have trend definition to it. So you're going to know by most oscillators which way the market's going, and it's which way the oscillator's pointing. So you're gaining momentum, gaining momentum. This is some common oscillators are CCI, MACD, price channel if you've got TradeStation, RSI, and stochastic. Most people have heard of at least 2 or 3 of these. And all it is you're going to have an overbought condition and an oversold condition. You're going to have, if in the MACD, the zero line's kind of that way. You're going, and it's not overbought, oversold, but it's trending up and trending down, right? The price channel, you've got overbought, oversold. You've got RSI, overbought, oversold. Stochastic, overbought, oversold. So the reason I put MACD in is because the MACD as an oscillator, it just goes up and down, up and down, up and down. So what you'll do is you'll see it cycle in the charts. So let's see how we start tying all this stuff together, and we start talking about divergence. Okay, so here's another term you're probably aware of, but the power that divergence gives you in calling market tops and market bottoms is second to none, in my opinion, because what divergence is, away from the Investopedia definition, the divergence is hidden clues. Okay, and why do I say hidden? Because a lot of people have been schooled, if you're oversold, you just sell the market, right? Because it's got, or I'm sorry, if you're overbought, you sell the market because it tends to be going too far, right? And if it's oversold, you buy the market because that's a good value. Well, the divergence takes the counter's position there, and that's why I call it a hidden indicator. It's hidden because not everybody looks at it, and even the people that look at it, what did I tell you happens in those market conditions? People get emotional. And when people get emotional, they forget about the hidden things. If it's not right in front of them, they tend to forget about it. So a lot of times, if you look back at the day, the top or the bottom of the market for that day is going to have a divergence signal. It's going to have those hidden clues that tell you the price is running out of steam. Okay? So if everybody's with me, let's go over divergences. What types of divergences are there in the market? There's bearish divergence. That's when price is making higher highs, and the indicator, and I don't care what indicator you use, I prefer you using oscillator type indicators, but I mean any indicator can get weaker. The indicator, as price is making new highs, the indicator is getting weaker. Okay, and I'm going to let that sit in for just a second. As price is making new highs, the indicator is getting weaker. Because think about what you're looking at on the chart. Everybody's saying, oh, I'm going to buy the next pullback right here, right? You know, all right, I missed this one, but this next one, darn it, I'm going to follow my plan. I'm going to, this thing is trending up, I'm going to get involved, and price is going to the moon. But your indicator's down here saying, you might not want to do that, Michael. It may be getting an emotional standpoint, Do you have something else that is saying that we're going up, that's going to override the indicator? Well, price overrides everything, but I'm going to tell you that when you get this situation, chances are you're at least going to get a reversal. You're going to get a deeper reversal, because when does the market move? It moves when the least amount of people can be involved. Well, if everybody and their brother is seeing this point and they're going to buy this, what is the market going to do? The market's going to come down here. It's going to make sure it takes out those stops, and then if it wants to go to the moon, it's going to go, right? Works the exact same way on the bearish side, or whoops, that was bearish divergence. Works the exact same way on the bullish side in a downtrend. In a downtrend, if you've got the price going down and it's making lower lows, if the lows are taken out, and you look over here on your indicator and you get a higher low on the indicator, then you're looking for a market bottom. Now, why do I call these low-risk market bottoms? It's real simple. As soon, and I mean to the tick, as soon as your price right here is taken out, your trade is wrong. Okay? So if I can get in right here at the first close, and I know I'm wrong right here, what does that give me? That gives me very, very, very limited, and I'm sorry I can't write with a mouse very well, but it gives you very, very limited risk. Because why? Because when price takes out this previous high, what's it going to do? It's going to, even if it takes a while, it's going to accelerate, and once the resistance is broken, the resistance becomes support, right? So we're getting in at a level that we can put our stop. We can be comfortable if we're stopped out. We were just wrong on the move. But if we are right, your reward is going to allow you to move your stop up. As you make new highs, you can trail your stop. Okay? That's why I call it divergence trading is low risk, picking tops and bottoms in a low risk fashion. Because I know absolutely without a doubt if I'm wrong or right on the move. Okay, I'm not sitting here wondering if is my stop just too tight, or should I just double down right here and see if it'll rebound? No, it's point blank. If you get taken out of a divergence trade, you're wrong on the trade, and that's going to happen. It happens sometimes. No big deal. The winners will outperform your losing trades because we're controlling risk so well. Okay. Let's look at the Russell this is a real-life chart I just stole from, I believe it was Friday's trading session. And I'm not looking for, if I'm trading on a 144 tick chart, I'm not looking for daily highs and lows. If this is a daily chart, then yeah, I'm obviously looking for some daily highs and lows. But what I'm doing here applies if you're a swing trader, you trade with the weekly trend, and you get in on the daily chart, okay? And that's exactly what I'm doing. You've got a trend defined, which I'm going to talk about in a second. You've got a trend defined, and you're looking for a continuation of that trend. So in this case, we're looking for a downtrend, and this market has come from up here. And now what we're doing is we're looking for retracement, and we're trying to spot a trend continuation. So let's look at just a basic indicator, a stochastic, and it doesn't matter what you pick. I'm using the default standards or the default settings in the charting package that I use, okay? Look, we talked about simple price pivots. Simple price pivot right here. Market continues up. Simple price pivot right here. Complete price pivot, okay? Complete price pivots, more powerful than simple price pivots. Simple price pivot gives us at least a starting point to compare the market moves, right? Well, look right here. This market move right here on the simple price pivot came here. We got an equal high on the indicator. Equal high on the indicator right here. So we didn't get a complete price pivot though. And then when we got a lower high on this stochastic, and a new high. Remember I showed you that on the theoretical chart? Well, this is real-world application. You get this close right here, you short the market, short right here, and your stop is above here, and you know if this market goes up to here, you're wrong on the trade, but you get that continuation. And what did I say? Oh, right here, look at this. The market's going up. I don't know if it's going up quite yet. I'm a new trader. I want some confirmation. Comes back, pulls back to my trend line. See, I knew that trend line was going to hold, and it made new highs. And it comes back down. I'm going to buy the next trend line. It looks like it might be rolling over. Nope, it's making new highs. So now you've got 1, 2, 3 points of reference. So even a new trader is going to have confidence to buy this, right? So they're going to sit there. We're going to get to the trend line. They're going to say, okay, I'm long. Well, what did I tell you the market has to do? The market's got to get rid of him, right? It's not going to go up because, you know, too many people can see it. So we've got a hidden clue when we made this top that the market's losing strength. And then you get the rollover. And I've got a chart here that's going to show that. I drew the lines where you can see them that line up. And you can see it's not off. I mean, it's with the pivot points. The price is getting stronger. The indicator's getting weaker. That's the divergence, okay? So let's talk about how I use this and what are my favorite trading situations. And my favorite trading setups and what is really, really prevalent in this volatile market, you get really rewarded when you're able to systematically call not necessarily daily highs and lows, but just intraday highs and lows with the trend. So what do I use? I use an indicator that I developed and had coded up. You don't have to have this indicator, but I'll show you it does make your life a lot easier. It's called the Ricochet. And why? Because price tends to ricochet off of these levels, and it's my divergence indicator. It shows when divergence is present and the pattern is complete, and that's important because we talked about the simple price pivot and the complete price pivot. You have to have a complete price pivot in order for the trade to be valid. So the pattern is going to be complete. Now, my indicator, I want an early, you know, kind of, hey, here's what's there. So the indicator doesn't wait for a complete price pivot, but it gets you that lower close on the bigger time on the oscillator that will give you the high probabilities, okay? So if you wanted to wait for absolute confirmation, once the indicator fires, you wait, you know, and you can get that lower close and take the trade. Scalpers use it to follow the intraday trend. Longer-term traders can use it to spot reversals, spot those tops and bottoms. And remember, an intraday trader is spotting a top and a bottom. He's just spotting it in the overall trend. You know, he's using a couple of more things. And this indicator is not a standalone indicator. It complements other tools and filters out your parabolic moves, okay? So if you're coming into a pivot level and you just blow through that pivot level, if you wait for a divergence signal, a lot of times you won't get just run over by the market because, and there's a fine line between waiting for confirmation and then taking key predictive levels. But the parabolic moves, it actually filters those out if you're a predictive level trader, like a pivot trader or coming into new highs and new lows and things like that, okay? So let's look at this, and this is absolutely my favorite setup right now in the markets. And it's what I've been using the last few days, even in the trading room. I think, was it Thursday or something, we were able to intraday catch 105 points in the Dow using this simple technique. Now, I've got a lot going on this chart, but I'm keying in on the Ricochet because that's what I want you to make sure that you are aware of, and that's the divergence pattern. Now, I don't have the oscillator on here. I'd use it to save space. So that's one other good thing about the indicators. It saves space. You don't have to clutter your charts up with all those indicator subgraphs on your chart. It just pops up here. It shows you that we get a simple price pivot, and then this close gets a complete price pivot. The market is in a downtrend because I've got some moving averages here, so I know I'm only looking for bearish divergences. And then you get another one right here. The market tanks, okay? So obviously, you know, we can use that and it would be a great benefit, but here's a 1 minute chart. You get the move up. I've talked about key levels. These are ATR levels from the other day, okay? You combine this. It is a very good complementary indicator. You're in the ATR levels, the 100% and the 120% ATR levels, and you get a divergence trade. You come back.
Hey, Michael, I don't mean to interrupt. I just want to give you a quick heads up. We're looking at about 5 more minutes.
5 minutes. All right. We'll be able to wrap up in that time. So we were at the key levels, and what I said was once you get these levels, price is going to hold those. So you get the downtrend, you get the move, and for a scalper, here's 100, 150 bucks, right? So for a scalper, that's a pretty good move. Or if you're a longer term trader, you know where your stop's got to be, and you're looking for the market to continue until it takes out this level. Comes back up, gives you a chance for re-entry, and then goes on down. Why do we ignore this signal? Because we're at the key levels. We know that the market has a very high probability of this being the high level, right? So we don't want to get run over. We don't want to just short this level. We want to wait for the divergence signal, okay? Very important. Watch those price patterns. Watch the relationships between the highs of the price and your highs of your oscillator, okay? We can look right here. Corn, it doesn't matter which market. The indexes are offering great opportunities, but corn, even you're in a downtrend in corn. I think everybody knows that. That we're in a downtrend. Now, this was a previous downtrend because you can see the prices here are a little old. But you get bearish divergence in a downtrend, bearish divergence in a downtrend, bearish divergence in a downtrend, and the market's going to go. If you were at a key level, then you'd be looking for the other trade setups. But we're going to filter these out because we know the price is in a downtrend. Okay, so let me go ahead and, like I said, it works on stocks and everything. I'm doing whoops, and I forgot, I must not save this. I'm doing a live divergence training, and you can sign up for this at www.tradethesystem.com/ricochet. And what you've got is the training session is a 2-hour session, and it's reversal trading blueprints. What I'm going to do is I'm going to outline every one of those trades that I just went over. I'm going to give you the rules, and I'm going to show the trades that set up live on the 28th from 9:30 to 11:30. I'm going to show those in a live market condition. We'll put them on, and if the trade setup meets my criteria, I'm going to trade it live. And most of the time in a session, we'll get 3 to 8 setups in either the Dow, crude oil, or soybeans. Okay, so it's during live market hours, November 28th, 9:30 to 11:30. Normally we do a live trading event. We charge $297. I will knock $100 off of that. And since I want to make sure everybody understands, and I'm going to be taking questions, we're doing this actually again. So we're limiting the number of people, and we're going to limit it to 30 people. Now, the bonus I'm going to throw you is if you have TradeStation, Ninja, Thinkorswim, or Multicharts, and Multicharts has an asterisk because if you got TradeStation, it should work in Multicharts, but I'll probably have to help you a little bit getting it installed. But if you've got one of those 4 indicators, I'm actually giving you the Ricochet indicator package for free. Now, if you don't have them, I guarantee you will still get $197 worth of value out of that trading session, okay? The indicator includes divergence on a proprietary formula that we have. I call that, it's just the TTS one, the CCI, RSI, MACD, and stochastic. It can be used on daily charts to do swings for stock traders, and you can get that at www.tradethesystem.com/ricochet. Come spend a couple hours with me. It'll be well worth your time, and everything that I do, if you're not completely satisfied, I'm going to give you your money back. So if you come to the program, you don't like it, or you can't, you say it's not valuable, you call me up, you say, Michael, you said no questions asked, I want a refund, and I'm going to refund you. I don't have many refunds. I'm going to tell you that if you have one of those platforms, you're getting 10 times the value. If you don't have one of those platforms, you're still getting a tremendous amount of value by uncovering and seeing those patterns traded live, as well as the complete plan on how to systematically call the tops and bottoms. Okay, so I'd love to take some questions, but I think Reed is probably getting ready to cut me off. but I will try to answer one or two questions, and then I'll turn it back over to Reed. I do want to thank you guys for your time and spending your time here, taking your time out of your Saturday. And I do want to thank MTI again and Reed for having me come on and share some information with you. What do you need if you're watching the MACD? The indicator package, you just need the MACD on your chart, and you look for lower highs when price is making higher highs, or higher lows when the price is making lower highs. And I may have said that wrong. But you're just looking for the divergence, one doing one thing and one doing the other. For all my trading, no, I don't use the 144 tick for all my trading. It depends on the volume in the market. The ES, you're going to have to use like a 233 or a 377 because the 144 tick chart's going to probably be a little too quick for you. It's too quick for me. So you want something that, like I said, my sweet spot is 3 to 8 trades per day. So I like to use the 144 tick in the Dow and the Russell because the volume, you know, that's how many setups it gives me. All right. Reed, I appreciate the time. I am done. If you guys have any other questions, feel free to email me, michael@tradethesystem.com, and I will get back to you as soon as I possibly can. Hope you enjoyed it, and I hope to see you at the training on the 28th.